Hi there and welcome to another video on my channel. In today's video, we're going to focus on default insurers. Now, what is mortgage default insurance? When you purchase an owner-occupied home in Canada with less than 20% down and obtain a mortgage with a federally regulated financial institution, the mortgage must be insured with CMHC, Genworth, or Canada Guarantee. These are currently the three default insurers which operate in Canada. Now, there are lenders that can offer you uninsured mortgages for purchases with less than 20% down, but these lenders are either private lenders or mortgage investment corporations whose rates and fees are very high to the point where it's not worthwhile going with one of these lenders to save money on avoiding default insurance. Lenders such as these are there to provide mortgages for people that aren't able to qualify with federally regulated lenders. Default insurance is insurance for the lender, not the borrower. It offers protection to the lenders in the event that the borrower defaults on their mortgage, or in other words, ceases to make regularly scheduled payments. The amount of default insurance a borrower will pay is based on the amount of down payment the borrower will be coming into the transaction with. Pricing of default insurance premiums are set in tiers of 5% intervals, as shown in the chart below. Now, as you can see from the chart, if you were to purchase with 5% down, well, anywhere from 5% down to 9.99% down, the insurance premium applicable to the mortgage would be 4% of the mortgage amount. So, for every $100,000 of mortgage, that's $4,000 of premium. Also notice that the greater the down payment is, the less the default insurance premium will be. The reason for that is that the more equity that there is in the home, the less risk there is for the default insurer. See, when a borrower ceases to make payments on a mortgage, what happens is the home is sold to recover the mortgage. This is called a power of sale. Now, there are costs involved with selling a home, if they're using a real estate agent plus whatever other costs, legal fees, that kind of thing, which must be recovered with the sale of the home as well. So when you purchase with 5% down and there's a 4% insurance premium on top of that, that only leaves 1% equity in the home, and that would not cover the cost to sell the home. So there's a higher risk in this case to the default insurer. Default insurance premiums are added to the mortgage rather than paid up front, so the borrower does not have to save for the default insurance along with the down payment and closing costs. Let's say, for example, that you are purchasing a $400,000 home with a down payment of $45,000. In this case, the base mortgage amount will be $355,000, and since the mortgage amount will be between 85.01 and 90% of the purchase price, a default insurance premium of 3.1% of the mortgage amount will be added to the mortgage. So you can see from the equation below that the default insurance premium would equal $11,005 in this case, giving you a total mortgage amount of $366,005. Default insurance premiums differ for such products as the Alt-A product, which is designed for self-employed borrowers who have difficulty proving their income in a traditional manner. For Type B vacation properties, now these are properties which do not classify as four-season properties and may not have year-round road access. Second mortgages and mortgages for investment properties. Currently, mortgages which are insured receive the lowest mortgage rates available on the market. If your mortgage is currently insured and you are selling your home and plan to purchase another, the insurance is portable, so you do not need to pay an entirely new premium if you are repurchasing with less than 20% down. Any new money added to the mortgage will have to be insured as well, and the premium on the new money will be at a slightly higher rate than the standard premiums shown in the previous chart. These are called top-up premiums and are illustrated below. Now, although these premiums are higher than the standard premiums, please keep in mind that they're only applied to the new money added to the mortgage. So, let's say you have an insured mortgage with a balance of $400,000 and you're selling your current home and plan to purchase another with just 5% down. In order to purchase the home, you will require a $25,000 increase to your mortgage. In this case, the top-up premium added to the mortgage would be $1,575. If you were to reinsure the entire new mortgage rather than port it with a top-up, your premium would be $17,000. So you can clearly see the advantage of the top-up premium in the example above. If you find yourself in this scenario, it's extremely important to remind the individual, whether it be a broker or a bank representative arranging a mortgage, To remind them that your mortgage that you have on your home is currently insured and you'd like to explore the option of the top-up premium, because that broker or bank might not think of it. They might not ask you if your current mortgage is insured. They might not look into it on their own to see if that mortgage is insured. And you might miss the opportunity of saving so much money by just doing a top-up premium rather than insuring the entire new mortgage. Purchases of homes $1 million or greater cannot be insured. The minimum down payment for a purchase price below $500,000 is 5%. For any amount of the purchase price above $500,000, a down payment of 10% is required. So, for example, if you are purchasing a home for $625,000, the down payment required would be, on the first $500,000, $500,000 times 5% is $25,000. On the remaining $125,000, $125,000 times 10% is $12,500. So the total amount of down payment which will be required on a purchase price of $625,000 will be $37,500, or 6% of the purchase price. If you are purchasing in Ontario, Quebec, or Manitoba, provincial sales tax will be charged on the default insurance premium, and unlike the premium itself, this amount cannot be added to your mortgage, so it's important to save the amount along with your closing costs. So, thank you for watching. I hope this was helpful for you. If you did find it helpful, please leave a like and comment below. Also, if you have any questions for me, leave them in the comments. I'll be sure to get back to you. Until the next time, have a great day.